All right, the markets have been in absolute free fall. I think we have had red days in 12 of the last 15 trading days. And at one point, we were even down nearly 10% from all-time highs, as you can see over here. Now, at the time of recording, I think even though we had cooler CPI and the market actually bounced because of the cooler CPI, I think the matter of fact is that the SPY actually broke certain crucial support lines. And if they cannot actually reclaim these support lines, then there could be a further downward movement, especially if Trump continues talking about tariffs. So I think what we're going to do in this video is to basically help you understand how you can manage your portfolio in these volatile times. We're going to be talking about Trump, the economy, fundamentals, as well as valuation. So you have a better idea of what it takes to manage your portfolio and where it might make sense for you to start adding during this market crash and things like that. So this isn't financial advice. I'm just sharing with you what I'm doing for myself. Now, because the markets are crap, I think everyone likes to blame someone for their predicament. And unfortunately, for Trump, that person is him right now, because naturally everything points to Trump and his administration. Now, personally, for me, I have no horse in this race apart from the fact that I invest in US equities. But as a neutral outsider, I think what Trump is doing right now really seems to me like what he has been saying all along. But for one reason or another, I think people just didn't believe him, or they probably, like me, didn't see the implications of what he planned to do. I mean, I knew that he wanted to pursue tariffs, but I never actually thought that the market would react this way to the tariffs that he was actually proposing. So I really want to tell you what I think from my perspective. Like I said, as someone who doesn't live in the US, and my only stake in the US is in the stock market. You see, when the previous administration was in charge, it's not like I was, worry free. I was actually afraid that the US would run up a large amount of debt, so big that they could not repay it. And the moment that the US defaults on their debt, I think everything will go to crap at that point in time. However, with Trump, I think the worry is slightly different. I am worried about overly protectionist policy. Now, I do get the angle that some people are coming at this, explaining that he's actually using this to scare the markets in order to drive down yields and things like that. And I think he's really treading a really thin line. So I think, to me, I think while he's trying to put himself in this position of power to negotiate better deals for the US, I'm afraid that at the same time, while doing that, Trump may end up alienating some of his allies, and tariffs, at least when I, did a bit of reading, historically have been inflationary. And to me, all this does is it creates a little bit of anti-US sentiment in the market. And so to me, the concern basically just changed. It's not like with Trump, I have no concerns, and with the previous administration, I have plenty of concerns and things like that. And all of this, the way I see it is that it's part and parcel of investing, which is why we cannot be swayed by the macro environment, but we do have to understand it and use it to inform our investing decisions. Now, I do want to point out a couple of things. I think, reading some of his press conference, or looking at, oh my goodness, what am I trying to say? When I listen to some of his press conferences when he talks and things like that, I feel like his demeanor is slightly different this time around. It's just that his whole body language, the tone of his voice when he talks to reporters, he just sounds very, in control and focused. And so, I think with the people that he has around him at this time, the people that he has surrounded himself with, they are not typical politicians, they're business people, and they know how to get markets to move in their favor. Right, and so this is what I mean. Some of the tariff news that I was talking about earlier, these are the things that, and sorry, the reason why this is not working smoothly today, like I said, Murphy's Law, everything that can go wrong will go wrong. Mic is not working, can't find my Apple Pencil, using my finger to write. So any handwriting you see later on is done by my finger. And I also cannot go live at this point in time, so I have to pre-record the whole thing. Okay, let's carry on from here. Where was I? Wait, let me look at my points that I have. Right, I think we're here, which is that Trump will not rule out a potential recession this year. Like I said, from looking in from the outside, it feels like this time around, Trump is really in control. He knows what he's doing. He's surrounding himself with people that he can trust. And but even then, from the outside looking in, I know that he's doing what he feels is best for America. But at the same time, he's treading a really, really thin line. Because like I said, let's be clear, tariffs are inflationary, no matter how you want to spin it. I know some people are saying that because if you companies actually move manufacturing back to the US, the effects of inflation will not be felt as much. I think the concern that I have is how fast can all of these manufacturing facilities be moved back into the US. It's not like you snap your fingers and overnight all these facilities are moved back into the US. It does take some time for that to happen. So perhaps eventually it's not going to be as inflation. Eventually, it's not going to be as inflationary, but at least in the near term, before all of these manufacturing facilities are being moved back, that is what might happen. Now, however, personally, for me, I don't think he's actually going to cause inflation through the tariffs, not because I don't think tariffs are inflationary. I do think tariffs are inflationary. But if I look at, the broader aspect of what he's trying to do, he's actually trying to scare markets, at least I feel. He's using tariffs as a way to scare markets in order to drive down the rates and in order to, scare the economy to a little bit of a standstill so that inflation comes down at the same time. So to me, at least from the way I look at it, how this would actually work is that companies would, because of his eccentric nature, companies would tend to be a little bit more careful with how they spend money in case they have to account for tariffs in the later part of 2025. Now, in turn, that will slow down their hiring process, that will slow down the entire economy. And because of that, it will cause the consumer to spend less. And that is how it brings down inflation. It's not that tariffs themselves brings down inflation because of the manufacturing. I think that's a more longer term thesis. I think the more short term thesis of how tariffs actually bring down inflation is that the fear of tariffs stop people from spending so much because they want to account for tariffs. Otherwise, it's going to eat into their margins. Because of that, there's less hiring in the economy slows down, consumer starts to spend less, and as a result, inflation starts to decline. So to me, by doing so, what Trump is actually doing is that he's indirectly forcing the Federal Reserve to cut rates, because one of the Federal Reserve's dual mandate is actually maximum employment. Oh, right. Okay, so maximum employment, correct. So to me, I think the investors and hedge funds, when they see this, when they see the economy starts to slow down, when they see hiring freezes and things like that, I think they are likely to move their assets into safety by buying bonds, preparing for a recession. I think earlier on I showed you the article where Trump said that he would not rule out a potential recession, right? Which is this article that you see over here. And so because of that, that the buying of the 10-year treasury and buying of these 10-year bonds will actually drive down the yield of the bonds. So to me, while this might be painful for people like us who are holding stocks, oh my goodness, mortgage rates have started to fall in the US, and that is actually good for the people who are buying houses and things like that. So this actually brings me back to what I said earlier about Trump, being in a more having a more controlled and focused demeanor this time around. I think in his first term, he was really focused on the stock market, and I think many people actually thought that it would be the same this time around. But it seems like this time around, his focus is really on driving down the interest rates. And I believe the term being used by the Treasury Secretary, Scott Bessent, if I'm not wrong, right, is that the US economy is in need of a detox, right? I think he said it over here. Okay, there's going to be a natural adjustment as we move away from public spending into private spending. The market and economy have become hooked, and we have become addicted to this government spending, and there's going to be a detox period. So the entire administration seems to be moving as one. Trump is focused, Trump is controlled, everything is that is happening right now is seems to be exactly as what he wants to happen, right? I think the conflict comes because people didn't understand that when Trump says that he wanted to bring rates down, this was what he meant, and he's actually crashing all their stocks and things like that. So because of this, I think sentiment against him is shifting a little bit. I know even people who are pro-Trump, who have voted for him, are a little bit unhappy with how he has chosen to do things. But I think he's choosing to do what he really feels is best for the American public right now. So I'm not here to debate, whether or not you like him as a person. I think I'm more interested in what his policies will actually do and how we can position ourselves to benefit from his policies. Because, like I said, let's not kid ourselves, right? Whether or not you like him or dislike him, there are risks to his approach. He could drive the US into a recession, or even worse, if other countries band together against the US, we could really be in for a world of pain. Now, it's actually hard to conceive that actually happening because a lot of the biggest companies in the world come from the US. Google, Instagram, Facebook, and things like that. Tesla, Meta, Amazon, and all of these big companies actually come from the US. So it's hard to think that there's going to be any sort of prolonged trade war between US and the rest of the world. To me, I think this is more of Trump trying to rattle the cage, trying to get people to the table in order for him to make a deal. So I think it's true that if you compare the US to any one country in terms of its economy, the US has the larger economy and they would seem to have the leverage. But like I said, if Europe and Canada and some of these other countries come together and band together and tariff the US, that might be a whole different ballgame. And at the end of the day, I think if you look at the facts of the matter, if you look at what he has done, none of these tariffs actually seem like they're going to be implemented in the long term. I think everything he has said, he's always open for change within the next month or so. The tariffs seem to be just a tool for him to get people to the negotiating table. Now, I think with Canada, I really feel like just looking on from the outside, what it feels to me, especially these tariffs on Canada and why it's even higher than the tariffs he's implementing on China. He doesn't like Justin Trudeau. He really doesn't. He doesn't respect him. He doesn't like him. And he's just trying to, show him who's boss in a sense. I think you give it a couple of, I think, when is Canada's election? Soon, right? In a couple, one or 2 months. You give Canada some time, in a month or two, after their election has taken place, once they have a new prime minister that is elected in, and then we'll see a resolution to this. So until then, I think this tit for tat kind of trade war, with a mini trade war with Canada, will carry on for the next at least 1 to 2 months. But like I said, for Trump and his administration, nothing, when it comes to tariff, nothing seems to be set in stone. Everything seems to be open for change within the month or so. And I think we have seen a couple of times that he's, fully prepared to delay some of these tariffs altogether. So I think he's really using it as a scare tactic and to bring people to the table to do what he likes to do, right? To make a deal. And I think that's something that he has been harping on about how US has been shortchanged. And this is something that I wouldn't claim to have much expertise about. Whenever I read about countries being in a trade deficit, I think in the first world country, that's pretty normal. In some economic books, that's what you actually read about. I'm not too sure about this. I think everybody have their own opinions about this. And if Trump thinks that he doesn't want to be operating at a trade deficit, so be it. But I think at the end of the day, he's really trying to do what he feels is best for Americans. And for us as investors, our job is not to say whether or not this is the right or wrong decision, but to understand how to position our portfolio so that we are able to weather through this volatility. Now, because at the end of the day, I'm really also reminded by what Buffett said. You see, the moment I talk, I feel like I keep missing slides that I want to go through, right? Trump pauses tariff, something I've talked about. Yeah, and this is basically I wanted to show you that the S&P 500 rejected off certain levels. This purple line that you see over here, oops, now it's blue, you can't really see it, but this purple line that you see over here, this is basically the 200-day moving average. We have broken down below the 200-day moving average, and if we are not able to actually reclaim that back above, I think if we're not able to go past, I think 572 and carry on from there, I think we are going to break down even further, perhaps to the 540 range. So I think this level over here, oh, I really need to choose brighter colors. Let me try this over here. Yeah, I think this level over here, when the stock market eventually bounces back up here to the 572 range, I think it's important for us to see whether or not the market actually gets rejected off this level. If it does, I believe that, like I said, there's possibly another leg lower into the 540 range. And so to me, now is the time for us to do our homework, not when the market starts to fall, but right now, because nobody knows what is going to happen. For all we know, the market could just break past 572 and create new all-time highs, but we could also fall lower after we reject 572. And so that is why it's important for me to take times like this to reassess your companies and to consolidate your capital into your highest conviction companies. Because Warren Buffett has always said, right, he doesn't really pay much attention to the economy and to economists and things like that. And I'm going to quote him. He says that I don't pay attention to what economists say, frankly, right? This is what he said. Well, in this article, it says 2 years ago, but this article was back in, I think, 2019. Well, think about it. You have all these economists with 160 IQs that spend their lives studying it. But can you name me one super wealthy economist that has ever made money out of securities? No. But if you look at, the history of economists, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them. And I have a little trouble with that. This is what Warren Buffett has said. And I think the whole premise behind this is not that, we can actually totally discount macro factors, as we are going to explore later on. Sometimes macroeconomic factors does play a part in our investment thesis, but in the long term, if you invest in strong, fundamentally sound companies, they are going to be able to weather through the storms. And so, with that, I'll ask you to sit back, relax, and join the show. Perhaps you can put this on in the background. We're going to have a slightly longer show today than we're used to. We're going to be covering three companies, talking about their valuation, some of the fundamentals, some of the things I'm looking out for going into 2025 to decide whether or not they are a buy right now, and at what price points would make sense for me to, start to add again to some of these positions that I have. And for me, I really want to start. I think it should come as no surprise to you with my highest conviction play for this next 1 to 2 years, and that is SoFi. Now, the reason why I want to start here is because, I mean, Warren, like the quote I was just quoting from Warren Buffett, right? He's actually saying that, macro economics will actually, not really affect good companies, and I think SoFi is a testament to that. The student loans were taken away, and they pivoted their whole business, and they continued growing revenue, while other lending companies actually suffered as interest rate rise. And so that is why I have to start with them. You see, SoFi is a company who is projected to grow revenues at least 26%, as you can see over here. Maybe I shouldn't use this color. Give me a second. And red. Okay. They're projected to grow revenues at around 26% in 2025, and member count of I say over 30% over here in my notes. Actually, the real number that they have actually put over here is 28%. Now, the reason why I put 30% is because I really do not believe that they're only going to have member growth of 2.8 million members. I think Anthony Noto has been on record saying that, SoFi aims to grow member count between 800,000 to 1 million members per quarter. Now, even if it's on a net basis, I don't believe they're going to only grow member count at 700,000 members per quarter for the entirety of 2025, especially if, revenue growth and re-accelerating growth is going to be their focus for this year. Now, in the same period, I think we expect an EPS growth of 80%. I don't think they actually put the number over here, but EPS actually came in at 15 cents in 2024 and basically expected to grow to 27 cents in 2025. So between this to this, it's around a 80% year over year growth. Okay, so all of this would happen if, SoFi actually gives us the premise or the assumptions about the economy for this to happen. Interest rate cut is consistent with just 1.5 rate cuts. Now, currently, we are already pricing in 3 rate cuts. So SoFi is behind in terms of their assumptions over here. GDP expansion of 1 to 2%. This remains to be seen whether or not that will actually happen, and normalization of unemployment in the 5% range. Now, currently, even with all the firing from Doge and things like that, I believe unemployment is at 4.1%. So we are still a bit away from there, right? But this is SoFi's assumptions, and if these assumptions happen, this is the results that they expect to get, which is why I say I think they very likely are going to beat all of their expectations, as they always have done. So let's put things into context a little bit. Because I know it's hard, not to be swayed by the price action, especially when you perhaps bought this company in the $13 to $15 range. It ran all the way up to 18 and basically crashed down 41% thereafter. I think it really seems like we are back where it all started. But I think the fact of the matter is, if you were happy buying SoFi at $13 to $15, then you should be even happier buying it at $10 to $12, where we find it today. The only reason why you might be unhappy is because you were buying into the hype and you aren't really sure, whether or not this is a company you want to hold for the long term. And to me, this is the time where you actually do your due diligence to understand for yourself whether or not this is a company that you feel is worth holding for the long term, and whether or not it makes sense for you to continue to dollar cost average into this company. So buying SoFi today, you're actually buying them at an $11 billion market cap. So you're basically buying a company who has just grown its members from, I think, in the first quarter of 2021, their member count was over here. Yeah, the member count was over here, around slightly over 2 million members, and that has grown all the way up to where we are today at around 10.1 million members. Right, this is where we find ourselves today. in just this 3 to 4 year time frame, they actually grew members by 5x. Now, during the same time, the revenue per quarter, okay, this is not the year-over-year rev. This is not the entire full year's revenue. I'm just comparing it quarter over quarter. You can see every single quarter they're increasing their revenue growth, right? So in the first quarter of 2021, when they had 2.2 million members, their revenue actually came in at around $200 million in that particular quarter. But in the most recent quarters, they actually came in at $800 million. So that is basically a 4x in terms of revenue, right? So over the last 3 to 4 years, member count basically 5x and revenue per quarter actually basically 4x. So, and since Anthony Noto took over, which is in 2018, 2019, if you take a look at SoFi's annual revenue, right, they have grown their annual revenue by 6x since that time, right, from 400 million, slightly, I wouldn't say 400 million, I think $450 million or so back in 2019, all the way to $2.6 billion in 2024. Now, this is the company. If you look at this graph, I know the colors are a little bit, the colors are a little bit lighter over here. How do I get rid of this ruler? Oh, it's over here. This is, a company that if you look at this graph, you can see that there's a lighter blue line. The lighter blue line has been their guidance, and the dark blue bar basically represents their actual results. So you can see over here, this is a company that if you look at this graph, have never, ever, ever missed their revenue guidance in their history. And as long as they have become net income profitable, they have also not, missed their guidance in their expect. Now, conservatively, SoFi is actually, like I said, expecting 26% revenue growth in 2025, as well as an 80% growth in earnings per share. Yet, compared with companies like Affirm and Upstart, who are not yet profitable. However, these two companies are actually still commanding a higher multiple than SoFi, which absolutely blows my mind. If I'm not wrong, let's take a look over here. Affirm is trading at a 5.3 times price to sales, and Upstart 6.16 times price to sales, right? So with the current decline of SoFi's price, currently SoFi is only trading at 4.4 times price to sales. Now, all of this, right, if you consider like Upstart's entire business, sorry, what I'm trying to say is that if you consider the whole situation between SoFi, Affirm, and Upstart, SoFi's loan platform business, which is basically one aspect of their financial services business, just one aspect. It's not their entire business. It's just one aspect of their financial services business is equivalent to Upstart's entire business. And so when all things considered, if you consider SoFi's loan platform business, which is their newest addition to their entire business vertical, this one particular aspect of SoFi's business, their loan platform business, is actually Upstart's entire business. And not just that, SoFi is actually, doing this business with less risk compared to Upstart because SoFi has no loss sharing agreement. Yet, the market looks at these two companies and somehow still decide that Upstart is worth trading at a 50% premium compared to SoFi. So, perhaps because of that, I don't think it's wise to just only use the price to sales ratio. What I like to use is this thing called the PEG ratio, right? So price to earnings growth. So when you do that, you take a look at the current growth rate that we are expecting in 2025. If you look at the forward PEG ratio, basically we are expecting an 80% growth in EPS for SoFi in 2025. Now, and the forward PE ratio for SoFi, if I'm not mistaken, let me take a look. Forward PE ratio for SoFi. Yep, they're trading at a forward PE ratio of around 46. So they're trading at a forward PE of 46 times, right? So if you take 46 divided by this 80%, you get somewhere around what? 0.57 PEG, right? You get, is it 0.57? I think it's 0.57. Let me see. Yeah, you get 0.575. Wow, my math is not too bad, right? So this is what SoFi is actually trading at right now. They're trading at a 0.5 PEG, 0.57 PEG, if you want to be really exact. And so to me, I think, buying this company at $11, not not only are you getting a company that is trading at a point 0.5 peg, there are a couple of things that you can expect moving forward as well, right? If you see over here, it actually tells us that, SoFi plans to expand and reinvest into the company. So you like I said, they have to. So buying this company here at 11, I think there are a couple of things you can expect from them. Apart from buying it at a pretty good valuation at 0.57 times PEG, it's actually a fairly cheap valuation. But if you take a look at what SoFi is planning to do in the next year or so, you basically have a company that have grown revenues at a 30% CAGR over the last couple of years and member count at a 50% CAGR. Now, they were also doing that in an environment, right, where their core revenue product was actually taken away from them and they had to pivot and go after an entire new business verticals. So like I said, coming into 2025, now SoFi has told us that they plan to reinvest into the business. One of the first places that they actually plan to reinvest to is SoFi Invest. Let me see. Yep. At the moment, this was in their last earnings call. They actually told us that they have 2.5 million SoFi Invest products with 70% of the growth coming from existing SoFi members. So this is the aspect of their business that they want to continue to iterate on, that they want to continue to add value to their customers in terms of engagement and monetization. And they say that these two things, engagement and monetization, will double in the intermediate term, which means I would expect by the end of 2025. Right. So the other compelling fact is that our home loans business, so they are not just cross-selling customers and monetizing them in order to grow revenues through their financial services platform. They're also doing it in their lending platform. You can see in their home loans business, less than 2% of all mortgages are taken out by SoFi members. Right. So there is ample opportunity for them to cross-sell their home loans. And I've mentioned this many, many times before. I think their home loans are really being slept on because SoFi is a really narrative-driven company. For a period of time, they were the student loans company. Then, for the current period, they're actually known as the personal loans company. And eventually, if mortgages come back as they continue to scale this, I wouldn't be surprised if they become the mortgage company as well. So to me, there's ample opportunity for SoFi to grow and to grow in a way without incurring additional customer acquisition costs. So when you buy SoFi at $11, there are a couple of things you can actually expect. Now with SoFi, you're not just buying a company that to date has grown their revenues at a 30% CAGR and member count at 50% CAGR. They were actually doing so in an environment where their core revenue product was actually taken away. They had to pivot the entire business and go after entire new business verticals. So to me, coming into 2025, SoFi is very, very well positioned. They have told us that the aim is to reinvest into the business to drive long-term sustainable revenue growth. Now, they have pointed out a few areas that they wanted to do that. I think the first one being their SoFi Invest platform. Now, at the moment, SoFi Invest platform only has around 2.5 million products, out of which 70% of the growth actually comes from SoFi's existing members. Now, I think if you have watched my previous video, you would know that SoFi Invest platform actually only grew 6% year over year. So this is actually really, really slow growth. So I'm glad to hear that this is an aspect of their business that they're focusing on in 2025, and they expect engagement and monetization, both of them, to double in the intermediate term, which I expect to mean by the end of 2025. Now, the other thing that SoFi actually wants to expand their business on is not just in the financial services sector, but as well as in the loan platform, right? Not the loan platform business, but in their loan platform, in the way that they originate loans and things like that. Now, you see, SoFi's home loans business, right? Currently, less than 2% of all the mortgages taken out by SoFi are taken out by SoFi members, which means that there is a huge opportunity within the current existing member base for SoFi to cross-sell home loans to their members without incurring an additional customer acquisition cost. And I think this whole home loan side of the business is really being slept on by people. I think we have just seen mortgages or the mortgage rates have actually started to come down. And because of that, I would expect to see SoFi's mortgage business actually start to grow. You see, SoFi, to a certain extent, is also a fairly narrative-driven company, right? So because of that, I think in the past you have seen them being labeled as the student loans company. Now they're being labeled as a personal loans company, and I wouldn't be surprised for people to find them through mortgages and call them the home loans company and things like that. Now, to me, like I said, SoFi has are moving pretty fast in 2025, especially in the financial services and loan segment. You can see that Anthony Noto in the Bank of America fireside chat basically talked about coming up with a new product, a personal loan product that is interest only. And to me, I think this is a good product that is able to uh, go after a new, open up a new demographic to them, as long as it is still within the credit box that they are originally serving. Now, on top of this, they have actually expanded their loan platform business beyond just originating loans on behalf of partners. And I've explained this last week. This is basically what I call an infinite money glitch, where they not only help you to originate the loan, they securitize the loan for you by finding buyers, and then once the buyers buy these loans off their partners, the partners get the money, and they come back to SoFi's loan platform business, and then basically they can originate another batch of loans through SoFi. So they have actually originated a total of $2.1 billion worth of loans in 2024, in the second half of 2024. Now, they recently closed this $700 million loan securitization, which is about a third of the entire originations in 2024. So this is $700 million that goes back to their partners, and this is $700 million that their partners can again bring back to SoFi to put into their loan platform business, right? To originate new loans, and SoFi can receive fees from these originations. So on top of this, I think we actually see that their tech platform is finally starting to have some movement. I think they have decided not to wait for the big financial institutions, which to me is something that I really wish that they had done earlier. And they have broadened the scope of their customers by going after non-financial services companies, right? Companies who still need to use some of these financial products, but they're not by nature financial institutions. So you can see this with their partnership with their partnership with Wyndham. I think they are going after the debit card rewards market. This is a $4.5 trillion market. Now, to me, I think this is something that is exciting for Galileo, especially because nobody really goes after the debit card market. Even being the biggest player, even in a small pond, can be fairly lucrative. So, to me, this is SoFi's way of opening up their tech platform beyond financial institutions. And to me, I'm excited about this because their tech platform has always been a point of contention for me, and I'm interested to see how this actually affects their revenue. Because if their revenue starts to accelerate in the tech platform, it will definitely affect my own valuation. Because when I was doing SoFi's valuation in 2025, I was expecting them to grow between 6 to 8% in terms of their tech platform. Um, yeah, but I don't see how they can actually get to the low to mid teens in terms of their tech platform growth. But that was before I see their partnership with Wyndham and things like that. So with their tech platform moving in this new direction, this is something that is a distinct possibility that their tech revenues could indeed grow in the low to mid teens in 2025. So with all these things going for SoFi, right? I think at $11, I think depending on your time horizon and things like that, at least for me, this is a price where I have started to add again to my position, or at least sell cash secured puts below $10, right? Because I really do feel like the market might drop a little bit further. So for me, I'm not just buying at $11, but since it has dropped to the $11 range, I'm taking the chance to sell some cash secured puts at $10 and below. No, I think I accidentally scrolled to this page earlier on when I was talking about SoFi, but I think the second company that I want to talk about, which I have spoken about a couple of times on this channel, is Hims and Hers. Now, I guess if you are looking at this purely based on price action, if you're someone that doesn't know the company, you're just looking at the price action, the way that it has run up so much in 2025 and then come crashing back down again. If you're looking at it purely based on price, I think you could make the argument that Hims is expensive, which is why I really like the Peter Lynch quote that says, I think something like, the stock price is the most useless or the most not useful, most useless, I think useless, the most useless information that you can track. And yet at the same time, it is the most widely tracked piece of information about the stock. So I think with Hims, what we're actually buying, you're buying a fast-growing healthcare company that has a strong subscription revenue. Now they're building a strong moat by having a sticky product. Now I say a product, but I don't really mean a product like off the shelf kind of product, and I'll explain in a little bit. Now, the reason why I say their product is sticky is because they're not the product that I'm talking about. It's not medication per se. They're not actually, selling medication, but what they are is a platform business, and it is the personalization aspect of the healthcare that they can offer to customers is something that provides a moat for them against all the other big pharmaceutical companies, because these big pharmaceutical companies cannot provide the same level of personalization that Hims can to their customers. So because of that, you can actually see that subscriber growth has been amazing. Over the last 3 years, they 4x their subscriber count from just over 500,000 to 2.2 million subscribers. Now, more than half of these subscribers, I believe in the earnings call, they actually said 55% of these subscribers are currently on personalized solutions. And so what this means is that the medication that these subscribers are actually receiving is customized to them, either through form factor or through dosage, and this will actually suit the needs of the particular customer. And that is what makes Hims and Hers a platform different from other competitors who are just pushing products. Now, again, to me, I think this is fairly clearly reflected in their revenue, because during the same period that their subscribers were growing by this amount, their revenue basically grew in line with their subscribers, right? Revenue basically grew from 520 million to just shy of 1.5 billion dollars. All of this despite being a young company, and at the same time, I think what's even more impressive is that they're not one of these companies who are just growth at all costs, right? They're actually net income positive, and at the same time, they're also free cash flow positive. And to me, this is actually quite impressive for such a young company. So if you look at their latest earnings, I think they have told us that they have above 2.2 million members, right? More than 2.2 million members are on their platform, and they currently hold around a 47% market share. At least this is based on their own metrics, or versus who all these other companies at the side over here, who they actually consider as their competitors. Against all these companies going after the same market, they have a 47% market share. So I think it's quite safe to say that they are a market leader in this space. And I think, to me, what is even more crazy when I look at these metrics, right, is that basically they're just tracking the markets that they're currently operating in. And this doesn't even, consider or factor in the other markets that they're planning to go after, but they haven't started to build out that new healthcare vertical yet. So this is really bullish for me, like seeing in their existing markets, they're already the dominant market leader. And as they go after new business verticals, I would expect that market share to increase, to basically expand the market opportunity, and to continue for them to become the market leader because of the stickiness of their platform. So I think going into 2025, we expect Hims to basically expand into new specialties. I think they have already indicated over here where they plan to expand into in 2025. Now, this is not the video where we're going to dive in really deep detail about what they plan to do in 2025, but this is just something to consider as you're investing into the company. Now, in my previous video on Hims, I did say that I wouldn't be surprised if they are to actually see the price action actually come down 30, 40, 50% if we actually see semaglutide was actually taken off the FDA shortage list. I think nobody expected it to be so early in the year, but true enough, that was what happened. And we saw it fell all the way down from $72 back into the $40 range. Now, the recent sell-off in the market actually made that even worse, causing it to fall back down into the low to mid $30 range. Now, when Hims was actually trading in the $70 range, I saw a couple of comments telling me that there was no way that Hims could go back to this level of $30, $40. Buyers would step in at various points and things like that. And this is why I always encourage us to challenge our assumptions when markets are going up, and at the same time when markets are going down. Because when we invest in companies, I think many of us will tell ourselves that we are buying based on fundamentals. But to me, I think what I've come to realize over the years is that numbers don't lie. And if our buys are truly supported by the fundamentals, then the numbers will show that. You see, Hims did not deserve to be over $70 per share based on where their business is today. Now, could they be worth $60 per share by the end of the year if they really hit all their targets, right? $2.5 billion in revenue and things like that. Perhaps you can make the argument for that to be the case. And we'll explore that in another video where we talk in a little bit more detail about their valuation, but they're definitely not worth $70 today. No matter what growth story you have, the numbers behind Hims business basically does not support $70 per share. And that is why I always say potential is a dangerous word. You see, Hims stock did not rise because the fundamentals justified the run. There was basically a misconception that Hims is a GLP-1 business, and the hype around that basically pushed up the stock price. And to me, when the hype was gone, and the hype was gone when the FDA actually took the semaglutide off the shortage list, the stock actually fell. Now, as inaccurate as this perception of Hims was, it was really just the narrative around Hims, and it was the narrative, whether right or wrong, that was supporting the stock price, not the fundamentals. So to me, there are companies out there, right, like Palantir, like Tesla, who seem to always be trading at a premium. But I think that is also because at certain points they had huge industry tailwinds that are supporting their growth story on top of strong fundamentals, and that is not the case for HIMS. Now, HIMS has very, very strong fundamentals, but to say that they have an industry tailwind behind their back is a little bit of a stretch. Now, with Palantir, with Tesla, their business is global, and HIMS hasn't really reached that point yet. Could they? I would like to think so, that eventually one day they could bring their business global, but not right now. It's still early days for this company. And here's what the CFO had to say. You see, revenue growth in 2024, outside of the GLP-1, basically increased 43% year over year. Now, including the GLP-1, this was actually 69% year over year. So without the GLP-1, revenues came in at 1.2 billion. This, the words that he used, like this, basically reflect the ability to achieve the floor of our revenue expectations for 2025 a year early. Now, I know this might sound a little bit confusing, the way they phrase this, if you're not very used to listening to earnings call. But basically, what he's actually telling us is that, back in 2023, when we were making these projections, we had our estimates for 2025 as well. Now, these estimates in 2025 is probably $1.2 billion all the way to, let's say, $1.4 billion. Okay, and this is basically the floor or the low end of their estimate for their 2025 revenue, and they have actually achieved that a year early. And they didn't just achieve that a year early, they managed to achieve that a year early while totally discounting what many people consider to be a big growth driver for them in 2024 and 2025, which is the GLP-1, which I said is basically the wrong or a misconception that people have around HIMS. Now, with the GLP-1s, I think one of the good things that came out of this whole GLP-1 is really a boost in their revenue for sure, right? I think the online revenue per subscriber in the fourth quarter of this year came in at $73 per subscriber per month. Now, this is an impressive bump up from the $64 per month in Q3. But the real advantage to me from being able to ramp up their GLP-1 early in 2024 before the patents expire is not just about the revenue. I think importantly, it gives them the opportunity to test the demand and to build out the entire supply chain beforehand, so that when these patents eventually do expire, or if the shortage ever comes on again, they can just basically flip the switch and start producing, and they're good to go. And so even with this semaglutide taken off the shortage list, I think you can see over here how they addressed it during the conference call, that HIM's strategy is not just dependent on one drug, whereas their approach is that they're solving a problem in a particular healthcare category. And in this case, we're talking about weight loss. Now, if you listen to their verbiage or the way that they're talking about it over here, I don't think they're saying that liraglutide is as good as semaglutide. They're not implying that. I think we all know that this is not true. There are some trade-offs between the two, and I think liraglutide is a little bit more troublesome because of the number of dosage that a customer or a patient has to take. But you can see over here, HIM's response in their earnings call is that they actually look at it in a holistic manner, right? They tell us that we see that our steady state weight loss offering being primarily composed of our evolving oral-based solution. So they have their own solution to weight loss. All these additional products like GLP-1s, the liraglutides, the semaglutides, all these things are additive to what they already have. But the ability for them to solve the weight loss problem within this healthcare vertical is not dependent on any one product, but an entire ecosystem that helps the end consumer with weight loss. So to me, when you're buying HIMS at this $32 range, you're basically buying them at around a $7 billion market cap. Now that means, if they had revenues of 1.4 billion, if I'm not wrong, 1.5 billion in, I believe this number is not 1.5 billion. I believe this number is closer to 1.47 billion. So if depending on what number you use, you're getting them at somewhere between a 4 to 5 times price to sales. If you're buying it at $32 per share, right? So at the same time, they have around $300 million in cash. So they are fairly safe, they're fairly well capitalized in terms of cash and short-term investments with not much debt. Now, if you look at their 2024 numbers, like I said, they basically came in at $1.47 billion in revenue. Am I right? Say that? Yes, $1.47 billion in revenue. Now, adjusted EBITDA, that came in at $177 million. this represents a 12% adjusted EBITDA margin. Here, 12% adjusted EBITDA margin. Okay, let me just move this a little bit so that we are not confused. This 300, where should I put it? Over here, 300 million. Can I make this smaller? I think I can make this smaller. $300 million, this is basically the cash that we're talking about. Okay, so the adjusted EBITDA margin is basically 12%. Net income, as you can see over here, where it came in at $126 million, which is 8.5%. Now, but one thing very important for us to point out over here is that their net income margin is actually not 8.5%, because if you look at their numbers, I think what you'll realize is that this number is actually closer to 5%. Now, the reason for that, basically 5% is around $74 million now. Okay, and the reason for that is because they had a tax benefit of over $51 million in the third quarter of 2024. So this is a one-time benefit. You offset that, actually the net income margin is closer to 5%. Now, if you go into 2025 and we assume no margin expansion, they basically, achieve their 2025 revenue estimate of around $2.4 billion that they have shown us over here. That is around a 63 to 64% year-over-year growth in terms of revenue. Now, at 12% EBITDA margins, okay, if you get 12% EBITDA margins, basically your EBITDA will come in at around $290 million. Now, this basically represents the midpoint of their guidance, 12% EBITDA margins. And in terms of net income, if they're operating their net income at around a 5% margin, that will put net income at $121 million. Now, this number here is pretty significant because this represents a 64% year-over-year growth. Now, why is this important? Is because we're going to use this number to calculate the PEG ratio for HIMSS. Now, at $121 million, right, this would actually represent a PE, a forward PE of around 57 times, right? And if the growth rate is 64% year-over-year, and we take 57 divided by 64, I think this is close to a 0.9 PEG. 57 divided by 64. Yeah, 0.89. So if you round up, you get a 0.9 PEG. So this is what you're getting by buying HIMSS at $32, $33. But if you expect some margin expansion, let me see. Sorry, I can bring it to the next page. I guess I'll add a new page over here, and then we can see how. If we do expect a margin expansion, like I said, revenue no change. Okay, the revenue for HIMSS $2.4 billion. Now, if we expect some sort of, in terms of margin expansion for HIMSS, let's say margin expansions with 14% EBITDA, 14% EBITDA margin, 14% EBITDA margin, and 6% net income. Okay, that means that EBITDA should come in at $338 million. Now, this $338 million is just slightly above their high-end estimate. So it's not actually out of the realm of possibility. And if you think about net income coming in at 6%, this would put the net income at around $145 million instead of $121 million. Now, that would mean a forward PE of around 46 times. Okay, growth rate of, let me see, what's the growth? 145 divided by 74, which is this quarter, you get around 95% year-over-year growth. And if you take 46 divided by 95, you end up getting a PEG ratio of 0.48. Now, and beyond that, I think what you're buying when you're buying HIMSS at $32 to $33, I think if you expect them to expand their margins going into 2025, then you are getting a fairly good deal. If you don't think that they can expand their margins going into 2025, then perhaps you might want to wait for the stock to fall a little bit further. So that really depends on your own assumptions for the company. But I just want to point out a couple of things that I picked up during the earnings call. Because like I said earlier, it's really important for us every time we make certain assumptions about the company to challenge these assumptions. So why is it I think that this company can actually expand their margins in 2025? Well, a couple of reasons. Economies of scale for one, because in the earnings call, I think the CEO was basically asked, Andrew Dundam, he was basically asked whether or not Hims can actually get to 10 million members, and whether that's the goal. And he says in terms of subscribers for onto their platform, I think 10 million subs on the platform feels really quite in reach. And this is what he says. Now, from a straightforward growth standpoint, if you look at historical growth over the last 5 to 6 years, my hope and personal ambition would be to try to achieve this in the next 5 to 6 years, which means 10 million members by 2030. This is actually quite impressive. This is actually a 24-25% CAGR in terms of subscriber growth through to the end of the decade. And I think previously, the worry that I had about the scalability of their customer acquisition growth is basically also addressed in this particular slide over here. Now, two things I want to point out. Firstly, you can see that they have pointed out to us that their marketing spend as a percentage of overall revenue has decreased to 46%. However, when you look at it over the last couple of quarters, this is not really a trend, right? This is not really a trend that we can. Or is it a trend? Oh, sorry, this is not 4 quarters. This is just last 2 quarters over here, and then this is basically last 2 years. So on a year-over-year basis, it has dropped around 5%. If we can see a further drop to 41% in 2025, that would be fantastic, especially since we are not ramping up any new GLP-1 products. Perhaps their menopause product will need to see some sort of ramp up, but I think let's see how they manage the cost. But I think from this graph over here, we can see that management has been really, really good in managing the cost. So you can see back in 2019, right, they paid 12 million, I think it's in millions. Yeah, they paid $12 million in terms of customer acquisition costs. Now, in the first quarter, the customers actually generated them $1 million, that particular cohort, Q1 2019. In the next quarter, generated them $4 million. And in the third quarter, generated them $6 million. Now, it means that in the first quarter of 2019, the cohort that was onboarded into Hims platform, in the first quarter of 2019, Hims basically spent $12 million to acquire these customers. And yet, after three quarters, that means 9 whole months, they only made $11 million for the company. And it's not until the fourth quarter, basically the full year, where Hims start to see a return on their investment. However, in 2024, when they measured the Q1 2024 cohort, you can see the cost incurred to actually acquire these customers is around 113 million. In the first quarter, these customers already spent 69 million. This is in terms of gross profit on the platform. And in the second quarter, this shot up to $101 million. So that means within the first 2 quarters of acquiring the customer has already become a positive return on investment for the company. And because of that, their marketing model works. And so to me, this ability for them to scale their marketing in this way is something that is margin accretive and will make them have better margins as they continue to onboard more and more customers onto the platform. Additionally, if you think about it, Hims is as a platform business. The moment that a customer is onboarded into the platform to perhaps try out a certain product in one particular health vertical, Hims can actually make use of their diagnostic model to actually point out certain other healthcare issues that are related to what the customer is being treated for, and the customer, starts to personalize the medication in order to treat all these different healthcare issues. So, like I was saying earlier, sometimes I think they started off as an erectile dysfunction company, or a company known for that kind of medication, that ED medication. And I think what they have found is that many people who think that they are just suffering from ED usually have another root cause and underlying cause. And Hims is able to pinpoint these 2 causes and not just treat the symptom, but treat the root cause as well. And that, to me, is something that makes the customer sticky. And every new product that the customer uses on their platform is a customer that is being really just tied down to the platform in a good way, tied down to the platform, but at the same time, they don't incur any additional customer acquisition costs. So this is a really scalable model. Now, you're getting a company that is also at the same time aggressively expanding their capabilities to personalize treatment for their customers, which they have made 2 recent acquisitions of pharmacies. And this basically allows them, in their own words, they use this word, to verticalize their supply chain and increase automation. I think they have said it over here. So I think these are things that, as they become a vertically integrated platform, as they continue to increase automation in their pharmacies, I think this is ultimately going to drive up their margins, which is why, because of what I've said earlier, in the way that they have managed their marketing costs, because of these 2 acquisitions of new pharmacies that help to drive up margins. I do believe that in 2025, we'll see margins start to expand a little bit for HIMS, right? I think at the end of the day, they have told us previously that their aim for adjusted EBITDA margins is to be around the 20 to 30% mark. So they still have some ways to go. Now, at the same time, HIMS are also expanding their lab diagnostic capabilities. This basically allows them to make better use of data to give their subscriber deeper insights and to better diagnose their subscribers, and for them to basically have a generally better experience while using their platform. And I think all of this, in essence, basically positions HIMS in a place where they can build out very easily different verticals of their business. And each of these verticals contains more than one product, right? Which is why I say, despite the removal of a particular drug in terms of the semaglutide from the FDA shortage list, this is not something that is going to affect them drastically. And HIMS has already positioned themselves to become a durable long-term market leader in various aspects of the healthcare industry. But I think, to me, in a market downturn, I think it's good to have a company that is already a steady compounder and not everything is, full on growth. Because I think during a downturn in the economy, it is these growth companies that are hit the hardest. And so the next company is probably my second biggest holding after SoFi. And apparently people say it's dying. So let's take a look at Google. Now, there's always been some sort of narrative, I believe, around Google. Let me get to that slide. Yeah, there's always been some sort of narrative around Google, especially with how fast AI is moving. That the current sentiment that people have towards Google is that all these LLMs like ChatGPT and Grok and things like that, they're going to erode the search engine or the moat that Google has around search. And so, like I said earlier, the numbers will prove the thesis. Now, earlier on when I was talking about HIMS, like I said, the stock price was actually supported by a narrative that wasn't grounded in fundamentals, right? People actually pumped up the stock. People were hyped about HIMS because of the GLP-1s, but GLP-1s isn't the fundamental thesis for HIMS. And because of that, eventually the company came back to the fundamentals. And so for Google, I think the opposite is true. I think what we are seeing is that the narrative, or the false narrative, is actually pushing the price of this company below its fundamentals. And if you look at the narrative that search is dying, this is something that might sound quite concerning. But if you just ignore the narrative for a while and just look at the numbers tell you a completely different story. If you take a look at revenues over here, revenues basically grow from $75 billion all the way up to around $350 billion over the last 10 years. Now, if we zoom in a little bit on a quarterly basis, I think what you can see over here, yes, there is some seasonality. Every single year, first 2-3 quarters are a bit slow before it rises, and before it rises again. But if you draw a straight line up from the first, if you draw a straight line connecting points to point, uh, and so if we focus on the numbers, I do believe the numbers tell us a slightly different story for Google. Now, if you take a look over here, on a yearly basis, back in 2015, Google was only making around $75 billion in revenue. This increased all the way to around $350 billion in revenue over the last 10 years. Now, if we were to zoom in a little bit, what we noticed over here is that on a quarterly basis, this we see some seasonality in terms of their revenue, because I think largely because a large part of their business is search, and advertising is a rather cyclical industry. And so that is why it's important for Google to build up different arms of the business. But if you are just looking at Google search over the last 3 years, despite the seasonality, you can see that it is in a general uptrend if I connect point to point over here, right? And if you take a look at the numbers in 2024, what you can see over here, in the first quarter of 2024, we saw 15% year-over-year growth, Q2, 14%, Q3, another 15% year-over-year growth, and finally a 12% year-over-year growth in the fourth quarter of 2024. Now, in terms of Google's numbers, it's not just the revenues that are growing, but the profits are growing as well. Yes, there was a dip sometime in 2022, but they have since recovered from that all the way. I think during the dip, this was at around $15 billion. Now this has risen all the way to $25 billion, which means that they're operating at around a 30% net income margin, right? And this margin, to me, should really expand as they continue to scale their Google Cloud business. And when you take a look at their free cash flow, I think this is a little bit more lumpy, but that is largely because of the reinvestment into their AI infrastructure recently. However, if you were to zoom out from here, you can actually see their free cash flow and their free cash flow margin is expanding in a very, very healthy manner despite all their investments into the AI infrastructure, right? So their free cash flow basically grew from around $10 billion back in 2015 all the way to about $55 billion or so in the last 10 years. And this is free cash flow, mind you, which means it is after all their investments into the AI, they still have $55 billion of free cash flow left, which at this point is more than enough to buy up the entire SoFi and HIMS and still have change left over. Now, from a valuation standpoint, I think Google is really the cheapest of the Mac 7. I think you can see over here that despite the fears that people have about Google search, their search revenue is still increasing, 48 billion in 2023 and 54 billion in 2024. But it is because of this fear of their search, the moat that they have around Google search eroding, which is why it is currently priced as the cheapest of the Mac 7. Now, in the Mac 7, I also do own Amazon, but at these prices, I would prefer buying Google. Now, historically, I think Google has been trading in the mid to high 20s in terms of their PE ratio. Now, if you were to just draw a line of best fit, I think you'll agree that the line basically, is it over here? Maybe it's slightly higher than that. Right? Perhaps the line is slightly higher than that. Let's see. If I were to move this, can I move this? Yeah. Where would we say the line is? Line of best fit. Somewhere here? I would say perhaps a mid to high 20s, somewhere between the 26 to 28 times PE. I think that's a fair range if you have to look at this graph of where Google tends to trade around between the 26 to 28 times PE. And right now, they're currently trading at around a 20.9 times PE or 21 times PE. So they're quite far away from where they usually tend to trade. I think currently they're also trading at a forward PE of around 18.5 times. Let me see whether I got. Okay, so I'm going to write it over here so perhaps you can see Google. For Google, their PE ratio right now, in terms of the trailing 12 months, this is around 20.9 times. But in terms of the forward PE ratio, that means in 2025, they're actually trading at around 18.5 times. And in 2026, I believe they're trading at around a 16.5 times. Now, why is it I'm pointing this out to you? Because I want to compare for you where Google stands in relation to the broader market. So if you take a look at the S&P 500, currently the S&P 500 is trading at a 26 time PE, which means that if we do enter a correction where the markets fall more than 10%, purely based on a valuation basis, Google will be a little bit more insulated compared to some other companies. Now, additionally, for Google to outperform the markets, they just have to continue executing at their current rate of growth, which means they do not have to accelerate growth going forward. But as long as the narrative around the company plays out and people start to see that their search business is not fully dead, we can actually see the price start to move from multiple expansion. Because let's not forget, this is exactly what happened to Facebook a couple of years ago. I think they were in the exact same position where people were unhappy with Mark Zuckerberg exploring the metaverse, burning money quarter after quarter. And so the stock fell all the way down into the 80s. But the moment they stopped that experiment and refocused the company, that is ultimately when the people start to appreciate it once again as a cash flow machine, and the market start to apply a multiple that basically appreciates the business for what it is. So I want to take a slightly different approach over here. I think beyond talking about the headline news, which is like what is exciting for them, Google Cloud, perhaps even way more. I want to talk a little bit more about the qualitative aspect of Google's searches mode. Sorry, but before I do that, I realized this is something that I missed out. Okay, so early on, like I said, over here, Google's PE ratio, 20 times, 18.5 times in terms of 2025, and 16.5 times in terms of 2026 PE ratio, right? And the reason why I'm doing that is because I'm also comparing the S&P forward PE ratio to Google's. And if you can see over here, in terms of 2026 numbers, let me zoom it in. The S&P 500 is trading at 19 times 2026 earnings, right? The S&P is trading at 19 times 2026 earnings, and Google is currently only trading at a forward PE 2026 of 16.5 times. So comparative to the broader market, Google is considered fairly undervalued. And to me, I think this is the kind of companies that I like to buy if I'm afraid of a market correction, right? Companies that are already trading below market value, that even in the correction, they'll be slightly more insulated because of the valuation. Okay, and so like I said, I think I want to take a slightly different approach. I think beyond talking about the and so like I said earlier, I do want to take on a slightly different approach, talking about the qualitative aspects of Google's search engine mode. Now, I think so far the number has proven to us that the narrative that search is dead is not true. At least it's not entirely true. Now, you can leave your comments down below. Let me know whether or not you think Google search will eventually be disrupted by AI, or how it will be disrupted by AI. Because I do find myself using Grok a lot more than I do Google search nowadays, because especially since that I've gotten the subscription, Grok 3 is really, really amazing. And to me, that is a fact, right? People around me are doing the same. Even my parents have started to learn how to use ChatGPT. Now, I think the one thing I've always had with Google is that the culture that they had in the company, at least from the outside looking in, they seem to be more about the vibes than they are about execution compared to some other companies, right? They're not bad at execution by any means, but I'm just saying they are a company that are more about the vibes than about real execution as well. I'm talking about companies like Nvidia, like Tesla, and things like that. So I'm making this assumption because they actually dropped the ball and allowed ChatGPT to have a head start over them when it came to the whole AI race in terms of the launching of the LLMs. I think Gemini's launch was a little bit more haphazard and faced a lot more difficulties compared to ChatGPT. But with how fast AI is transforming, I think let's not be too quick to rule them out. And I'm going to show you a couple of things to help you understand how I look at this situation and why I'm actually quite impressed with Google. Now, I'm sure Google's Gemini is a great product. I think you can see how Google has tried to integrate their AI into the various services that they offer, right? Like Google Maps, things like that, using their AIs to as an AI overview to summarize the search terms. And so the one thing that I want to point out is that Google does have some things that are pretty innovative. For example, notebooklm.google.com. Now, this is what this is. I'm not too sure if many of you know this. What this is basically a virtual notebook in a way. Now, what it allows you to do, very simply, is that on the left-hand side over here, these are sources. Now, the sources that you can see, some of these are actually YouTube videos. Some of these are PDF files, the shareholder letter from companies that I'm looking up. Pasted text, these could be text that I've copied from various websites, articles, and things like that. And at the same time, I can attach their quarterly presentations, their SEC filings, and things like that. And so what this does is that over here, after attaching all these sources, it allows me to ask questions. Okay, over here, they allow me to ask questions. And what this notebook LM does is that it reviews all these sources, whether or not it is video or PDF or websites and things like that, and basically come up with an answer and link you back to the primary source from which they actually pulled out the answer to your question. And so because of that, you can actually pull all this data together, and it really makes researching companies so much easier. Rather than you having to manually pour through all these earnings reports, you can just attach the reports into Google's Notebook LM and basically ask it a question. Now, I think there are some limitations to this still, because I think this is still rather new. But I think it's fairly good, right? They can tell you the trends that they see and things like that. I think one thing that I have to say to me that is a little bit clunky about the whole experience is that I think this is not like Grok. I think Grok is able to make interpretations, able to infer. I think this is more of a extracting data, putting the pieces together. Some basic level of inference is involved, not as much as compared to Grok and ChatGPT and things like that. But I think this makes pulling of data and researching a lot easier. Right, so Google may have fumbled the ball and they're playing catch up in a meaningful way. While they are losing to the LLMs in certain specific sectors of search. Now, take for instance, recently I was talking to a friend about the difference between capitalism and a welfare state and the benefits of each. And I mean, when I Googled this, because my friend actually studies very deeply into this and has a vast knowledge into this. So I'm really like a noob when I talk about this. So I went to Google AI as I was reflecting on the conversation to actually find out a little bit more. And so when I typed in, I think let me show you. When I typed in welfare state versus capitalism, it came up with this AI overview. This AI overview would actually link me to all these different articles over here, websites that I have to go through and read myself. But ultimately, I still had to click on the links and put the pieces together. Whereas this is way, way more seamless with Grok. Now, now you can see with Grok over here, they basically not just give you the points, but they actually give you evidence and cite it with examples. Now, while using Grok, right, because of the depth of the topic that we are talking about and how deep it was actually going, I have to confess that I didn't have the expertise to actually tell whether or not Grok was actually hallucinating and giving me any wrong information. So I actually asked Grok to please, oh, not this. Oh, I think I may not have attached the screenshot over here. But I basically asked Grok to basically verify itself to check its information for any form of hallucinations. And they actually did that, right? And they went through piece by piece every single point that it has mentioned to me about the topic, and then cited credible sources as well as gave different examples of why their statements were true. And so because of that, I found that actually quite impressive. It saved me a lot of time, basically compiled my research for me and allows me to read. Of course, I know many academics out there are going to say that ChatGPT and things like that are not good enough. But I think for the lay people to have a general understanding of things, it's a much better. No, nobody is. I think for academics who actually say that, I think my answer to you is at the end of the day, we're not going to use it to get a PhD. I think what we're comparing it to is whether or not this is something that can replace Google search. It's like saying, oh, Google search can make me as knowledgeable as a PhD student. It's not going to be able to do that, right? It's not going to be able to do that, even if you use Google Scholar. But what it does is that this makes searching more efficient. This condenses and consolidates the data in a way that is very usable for you, and in a way that, at least to me, it saves me a lot of time from having to read through all these different things and trying to piece the understanding of these things together, right? So to me, this is something that that the LLMs have over Google search. But I think one of the things that I want to note over here is that these LLMs, and that people to people who say that Google search is dead, when you take a look at Grok, what Grok is doing over here is that they're looking at web pages as well, which is basically, all these web pages. It's basically like Google search. It's just a more efficient way of Google search. So for people who say that Google is dead, it's not understanding that the one advantage that Google really has is the data advantage. They have vast amount of data collected over years and years and years. And so because of that, I do think that, people who think that the whole Google narrative is dead is a little bit exaggerating. But at least in this particular instance, I have to say that my experience with Grok was much better than my experience with Google search. But all that to say that I think that the search market is much larger than we realize, because it's true. We do see evidence of behavior changing, LLMs becoming more and more mainstream, but I think that only covers one aspect of search. And the numbers tell us a completely different stories. Because if LLMs are taking away meaningful market share from Google, their revenues would be affected, right? But if you take a look at Google's revenues numbers, they are not as affected as the headlines make them out to be. And so when I talk about a different aspect of search, what do I exactly mean? Right? What aspect of search hasn't been disrupted? Well, if you think about it, if I'm looking for directions, I'm still going to Google Maps. I'm not asking Grok how to get from point A to point B. If I'm looking for coffee, I'm still using Google because I do want to read the reviews. And so if you're looking at it from a consumer perspective, as an end consumer looking to buy a product or service, I think being able to read real, reliable reviews, Google is still the platform to go to. And we have to remember that ultimately Google is an advertising company. And what the number tells us is that despite, certain areas of search in terms of like researching and things like that, these areas are perhaps being disrupted by these LLMs. But in terms of advertising, advertisers are still choosing to advertise on Google. And Google's advantage is that they're able to localize and integrate all these data into their search engine for the end consumer. Because, like I was saying earlier, imagine if you're looking for coffee near me. Now, I've actually tried to search this on Grok, and this is what I get. I get 4 different options: Thus Coffee, Yakun, Starbucks, and Curry Cafe. Now, firstly, location-wise, might not be 100% accurate. There's no, apart from this, Sembawang Shopping Center, apart from that, there's not much. Is there Starbucks at Sembawang Shopping Center in the first place? Now I'm trying to think about it. I don't even remember if there is. It seems like there isn't, so there's a little bit of inaccuracy there. This is not exactly near me. Yakun toast is too general. Now, Yakun toast is basically Chinese coffee with toasted bread, right? Some I think in order to help you understand it, let's just call it a Chinese Starbucks. But I'm a little bit hesitant to call it that. I'm not too sure whether my Singaporean friends will kill me. But Chinese Starbucks, that's the easiest way to understand that. I don't even know where's Curry Cafe. Compare this to the results that I get via Google over here, the different ratings with all the reviews and things like that. So I think because of that, this is what I mean by you know the difference in terms of the types of search that we are talking about. If we are talking about doing research, then perhaps Grok and all these LLMs have the edge. The only problem is that when it comes to the current models of LLMs, it doesn't seem like they have found a way to effectively monetize it. Now, I think a lot of them tend to monetize their user base on a subscription basis, but as newer models come out, as newer models become better, there's no stickiness to their product. And so beyond that, we haven't really seen any substantial way for this to be monetized yet. And from that perspective, while Google has dropped the ball in terms of the launch of its Gemini AI, it is still early in this AI race. And even with more competitors, I think this actually expands the entire search marketplace, which means that even if they end up with a slightly smaller slice of the pie, as long as they can continue to increase their rate of monetization and to integrate their AI into their various products and services, I think Google can still do well going into the future. So therefore, I think for me, it is times like this when the market is falling, even in the last couple of days, right? Even as the market takes a breath, we have a little bit of a bounce. We have to take this time to really reassess our thesis so that if this is the bottom, we feel safe to buy on the way up. But at the same time, if markets get rejected at these levels and continue falling even further, we already know the companies that we want to invest in. We do not have to, panic and try and decide which companies to buy as the sky is falling down. We already know beforehand that when the sky falls, what companies are we going to buy, at what levels are we going to buy, and because these companies are fundamentally sound, we know that when we get these companies at good prices, that will make good entry price for us for the long term. And with that, we have come to the end of the video. Now, for those of you who have really stayed to the end of the video, this is how I'm going to know. Now, I want you to leave a comment below. Let me see. What am I going to do? Okay. For those of you who have stayed to the end of the video, stayed to the end, this part, hit the like, hit the subscribe button. Thank you very much. It has been over an hour. If you're in gym, if you're cooking, like I said, if you are driving, I hope we have reached safely. I hope your meal is nice, and I hope you are, well and fit and healthy and ending your gym session soon. But at the end of this video, I'm purposely leaving this to the end to see who actually watches to the end. And basically, next week in our live stream, basically what I'm doing is that I'm hoping that this live stream becomes a more and more regular occurrence for me. I'm still not really used to setting up the whole live stream and things like that. But I want to, give back a little bit for all the support you have shown me. So basically what I hope to do is that if you have certain companies that you want me to do a little bit of a deeper research into, like what I've done for SoFi and HIMS and things like that, please leave the ticker symbol down in the comments below, and I want you to leave it with a smiley face like this so that I know, okay, that you have watched to the end of the video. Now the smiley face must be 2 dots and a curve this way. The smiley face cannot be this way. And that is how I know you watched to the end of the video. Okay, so you leave me your ticker. So for example, you want me to do SoFi, you put SoFi and then with a smiley face. Now, if you see a ticker symbol that you want me to do a deeper research or a deeper dive into, and someone else has already actually wrote that comment down, just go and like the comment, and then I'll basically pick the one with the highest likes, and we'll do it next week. If it's a company or industry that I'm not familiar with, perhaps I may take 2 weeks to do the research. But basically, that is something that I'll be presenting to you on the next live video, right? And beyond that, we're going to do a little bit more talks about the market and things like that. And I'm sure as I get more and more fluent in this, I'm hoping to do this a little bit more often, and then we can see where this goes from here and where it takes us, right? And so with that, have a great night. Thank you for your time, and I'll see you in the next one.